I can get you a house with a 2.2% interest rate.
But rates are 7%.
How can you do that?
This is a very lucrative option.
Okay, guys, we are going to learn today how to get a 3% mortgage in this market.
Sign me up.
Yes. And we're here with Dmitry Kievsky from
you.
United Mortgage. And of course, we have Omar Sharif.
Thank you.
And Omar, I'm going to let you take this over because you know a lot about this.
So 3% mortgages in today's market with the 7% rates, right?
Correct.
Yeah, sounds like BS.
It's not. It's not actually. So this is part of creative financing, at least from an investor's point of view within real estate. And Dmitry, I'll go through what I understand, and maybe you could fill in the gaps because I haven't done it before. But I actually have a deal right now where that's a potential candidate we could use it for. So my understanding is right now, because we've had the past 3 years of extremely low interest rates, 2%, 3%, 4% rates, the market's kind of frozen because people don't want to sell their homes at these rates because any new home they buy is going to have a 7-8% rate, whatever it may be at this point. So the creative financing aspect of that is some loans that are government backed, my understanding, right? This includes FHA loans, VA loans, veterans loans, and USDA loans, farmland. As long as it's government backed, it can be assumed by the next person who's looking to buy the property. So by assume, I mean if you have a home has a $500,000 mortgage at 2.5%, that's gold. You never want to sell that. But let's say for whatever reason you need to relocate, you need to sell your property. How do you keep that loan in place for the next buyer to make it that much more enticing for your property?
Great question. Can you do that?
But more importantly, why would you want to do it?
Right. And how would I do it? I mean, how do I get paid off of that?
So if your home, let's say your home has a 500.
Because I want money.
Yeah, you want money.
But you're buying the home.
No, I'm not buying the home. I'm
you're
selling
the seller.
I'm the seller. How does the seller benefit from that?
The seller. So let's assume the number is 500,000.
Okay.
2.5% rate.
Right. Great rate.
And your home is worth 600,000.
Okay.
Right. So if you put it on the market today, Eric comes along, gets an appraisal, it's worth 600. But now let's say Dmitry comes along and says, I'll offer you 650,000 for it, but I want to assume your rate because it's such a low rate.
Right.
My monthly payments will be much lower than it would be if I pay market value for it. So that's 50 grand more for you. He gets a rate of 2.5%. His monthly payments are what, half of what it would be?
Much lower.
Yeah. So that's the gist of it. It puts more money in the seller's pocket.
So wait, does he give me that 150 grand up front?
He would have to, yeah.
Oh, okay.
Now the challenge is he has to come up with the
Just making
150
sure.
grand.
Well, that's the biggest thing right now. Exactly. And Omar, you said it perfectly. A lot of people in this market specifically are dealing with liquidity issues.
Yeah.
The only caveat to this is that you're going to have to come up with a much larger down payment. So it's not like a 3% down payment. You have to come up with the difference between what the seller owes compared to what the sales price is. So for a lot of people, they might not have that liquidity, but if they do, this is a very lucrative option.
Yeah.
So this is for people that are, let's say, more established with the type of down payments that they're going to have.
Exactly.
So someone could come in, buy an existing home from the seller, take over their existing mortgage because it's so inexpensive, and then maybe finance the rest on their own with cash. And this gives that seller an advantage because they can maybe charge a little more for their house.
Yeah, ideally. Yeah, that would be the advantage of it. Now, in order for them to assume the loan, they still have to go through the standard process of qualifying for an FHA, VA, or USDA loan.
So here's the biggest caveat, because a lot of people, let's just say they have 700 credit scores, which is a great credit score, but it might not be that lender's specific parameters. That's where it causes a problem. So the biggest caveat with an assumable mortgage is that the only option you have is to get qualified with that seller's mortgage company.
Right.
So if that seller's mortgage company has very strict guidelines, it might now enable a client to not qualify for that mortgage. Maybe that mortgage servicer is a credit union and they want 760 credit scores. Maybe they want certain DTIs, right, in lower percentages. So unless you fit all of the parameters, it might not be the best option. But if you do, and you have that great profile, an assumable mortgage is an amazing technique on how to be able to achieve a home and pay a lot less for it on a monthly basis.
So as the mortgage company, right, I'm the mortgage company, Eric's mortgage company, why would I want to allow anyone to assume this rate that's so low? I don't want that.
Well, you're already thinking about this. What if Eric never paid, or whoever that seller is, what if they never sold that property. They're still going to be getting the same amount of money at the 2.5%. The interest that they're going to be repaying back is the same thing. All we're doing is just getting another buyer in place of Eric to go ahead and now pay that mortgage. So typically, and that's, you're right, not everybody wants to just get 2.5% rate. They might want that new buyer to be paying a 7% or whatever the rate is. But at the end of the day, this is why there's a lot of controversy with these assumable mortgages. A lot of lenders are pulling out of it because they want the current interest rate. But this is a very lucrative option for somebody who can qualify for it. And the bank still doesn't lose money because they're still assuming that that seller is going to be paying that loan for the next 30 years.
Okay, so you obviously have done a lot of loan representations for people in the years past and even today. How many of these loans are actually assumable to start with?
The best thing to do is to always check your closing documents as a seller, because it's going to ask you on your promissory note, and there's a couple other disclosures where it tells you if the loan's assumable or not. It might say it's assumable based on certain conditions, and those conditions are based on any stipulations from that originating lender. But they'll be able to know which one's assumable or not just based on the closing documents.
As a standard rule of thumb, the assumable loans are from all government-backed loans.
Government-backed loans. So you covered it
Okay.
earlier, the USDA,
Yeah.
the VA, the FHA. We are hearing talk in the mortgage world that some of them are trying to pull back, a lot of investors. However, for the most part, they're still happening. It's still in their loan documents as potentially possible to do an assumable mortgage.
So most of those loans were not jumbo loans at that point. It would be fair to say.
Correct.
So the lower number stuff that's under $800,000.
Correct.
Yeah.
The conforming, yeah.
And if you've already gotten your, like if you're already in your mortgage, it's a done deal. Like whatever was in your note, whatever was, you can't go back and say, I want it now.
Exactly.
Okay.
Exactly.
So of that number of loans out there, where are most of them have a clause allowing them to be assumable, or
In the
that
last
was
couple
a
of years-
requirement in those programs that Omar mentioned?
Yeah, no, I'm seeing a lot of times it just says allowable with certain conditions. So the problem and the biggest hurdle is, because right now what we're doing as a buyer essentially is we're approaching sellers that might have already had that home for many number of years, where they owe so less than what they're trying to sell it for that it becomes very difficult for that next buyer to be able to come up with the cash flow. Your perfect example of an assumable mortgage will be somebody that just bought their house in the last 2 to 4 years.
Yeah.
They didn't pay down that much principal. They're selling it at a normal price, and now it's not that much out of pocket.
Okay.
Where somebody might have already had 20% down payment sitting there. This is an opportunity to reallocate that money to be able to pay the difference between what the seller owes compared to the purchase price.
How realistic is it to really make these transfers happen? And how do you approach people and be like, hey, I just want to take over your mortgage.
take your
I
mortgage."
want to take your mortgage.
So I have a deal right now where it's exactly what you mentioned. The buyer purchased it 2 years ago, paid $650 for it through an FHA loan, at 2.2%. Believe it or not, it's the lowest I heard.
Yeah.
Right?
Wow.
So they currently owe $600,000 on the mortgage at 2.2%.
That's sexy,
Why are they
2.2%.
I
He
want
wants
that
to
again.
move because he wants to
Right?
get into a different school system for his kid.
Okay.
But I told him you can't let go of a 2.2%
No.
rate. So
You
he's
could
the
pay
perfect
the
candidate.
money to get your kids sent to the different school system in lieu of actually taking the mortgage.
Yeah,
And of
but-
moving.
yeah.
You know what I mean?
So he did the math in private schools, and he said that it doesn't
okay.
it doesn't pencil out.
Okay.
So what he's so
He'll never see that rate.
Yeah.
we won't. So
ever.
the numbers I'm working with right now, we haven't officially listed it, but his house just this morning I told him it's worth about 750, 775, but with a 2.2% assumable rate, it's worth paying 900. It's worth paying $1 million for that house because the monthly payments will still be less than what they would be if
Wow.
he sold it at market value. Now the challenge is how do you get someone to come in with 300 grand cash for a house that's in that price range? So we'll see what we could do.
Well, I think there's people out there that will do it. You know, with the bidding wars today, there's,
Yeah.
no,
But
there's no inventory.
the challenge
Not
is
only
now
that,
it's an
if-
FHA loan, so the buyer has to qualify for the FHA loan and have $250,000, $300,000. That's
Right.
a tough ask.
Let me ask you a question. As a realtor, can you
Yeah.
put it in the listing that this seller has an assumable mortgage to make it more enticing for people that are seeing this house in the market?
So the MLS doesn't have a search criteria that says
Right.
that allows us to search for assumable loans. They should, but the best I've seen is in the listing description they've put this loan is assumable.
That's amazing.
And I've literally found, I've searched most of North Jersey, I found like 5 listings that have that. So most people are not even doing this.
Right.
Just put in
Right.
big letters, 2.2 rate.
Yeah.
Yeah, that's a huge way to getting other buyers in the door. Yeah.
And to your point, why would the buyer or seller do this? Part of it is
And why would the mortgage
the
company?
mortgage
do it?
company do this, right? Because the mortgage company, in this case, from what I hear, they don't want to do it.
Right, exactly.
Yeah, so
I wouldn't
I've
wanna
heard
do
that
it.
they take months just getting back and forth because they don't make money off it.
No.
In fact,
Yeah.
I read one of the clauses for one of the servicers, and it says that their standard fee is like $1,000 that they make, because everything it's a government-backed loan, so they may make $1,000 off the loan if it's assumable.
Yep.
Will the property have problems appraising if it's based on the interest rate?
No,
No?
the appraisal is going to go the same way, what it's worth.
Okay.
And there actually is no appraisal for an assumable because you're taking a loan.
Oh.
You're just taking
You're
over
just
the term.
taking
You're
it
assuming
over.
the regular mortgage, the years, the rate, everything.
Everything.
And whatever number you agree to buy it for, the rest you're paying in cash.
And you're paying it in cash. Interesting.
No.
It depends on the
You have to
market.
have
Like
that cash.
in Bergen County, I think it's more feasible to do it because you're coming up with a larger down payment than just 10,
Sure.
5, or 3%.
Mm-hmm.
For my home buying groups, predominantly speaking, a lot of my buyers are going USDA, no money out of pocket, FHA, 3.5%. They don't have the liquidity to do so. But for a lot of people, if you're buying a house in North Jersey, you're already used to putting out 20 to 30%. So
Yeah.
this could be a great opportunity to do this.
Yeah.
Now, do you see any secondary financing on top of that
That's a great
assumable
question. Yeah.
loan? Is that happening out there?
I have personally not done an assumable mortgage with a second, but what we're doing a lot, and even in Bergen County, it's happening because we are actually rolling out, well, we did roll it out, we're just rolling it out more for buyers' awareness, a down payment assistance program that doesn't have any limit on loan amounts or DTIs. So some people are getting that second mortgage to offset the liquidity they need to be able to now not come up with closing costs. Or instead of coming up with an FHA 3.5% down payment, they can come in, get a second mortgage, and have that down payment covered by a grant.
But that's for
Interesting.
standard mortgage, not
Standard, regular.
assumable.
Assumable, you could still do it. It's just I haven't seen a combo because chances are, this is the theory, if someone's walking in with this kind of money out of pocket, they probably don't need that second mortgage.
True. So part of what I've tried to get a better understanding of is, can you put a second mortgage on an assumable loan? And the answer I've come across is no.
A lot of times, no.
Yeah.
No.
Yeah.
That first mortgage lien holder is always going to have precedence, and if they don't want it, which they don't because it's dangerous, they're not going to do
Yeah.
it.
Because there should be a clause in their loan that says no second liens, right?
They won't have it on the assumable loan. It's just if you go and try to get an approval with assumable, then that's where that stipulation might come. They're not going to put the stipulation on that current owner because they might be able to get a second loan. Like everybody is free to be able to get a second mortgage
Okay.
provided that they qualify. But specifically when you go try to apply for an assumable mortgage, that's where that clause and stipulation come in. We don't want secondary financing involved.
Okay.
And it's also risky for the second lien holder because
Very
there
risky.
may not be enough equity in the property.
Yeah, so
Correct.
let's say the assumption takes place and we're done, and that person who bought it put up all the cash and bought the property. Is there anything after the assumption is completed that would keep them from getting a second loan, doing a cash out on the whatever balance they had
Home
left?
equity. That's
Yeah.
a cash out, right?
Yeah, I mean, I haven't seen anything like that. I think I've always guided people to leave that second mortgage for an absolute emergency. So specifically people that are using secondary financing to kind of mitigate the out-of-pocket expenses. I've always said in this market, it's impossible to get a third lien. So reserve that second lien for when you need it. Even cash out, you might not want to change your 2.5% rate on a cash out.
Who has
but
a
you might
third
want to take
lien?
in 2008, that's all it was. We were paying off
Wow.
third, fourths. It was
Wow.
ridiculous. But those lien holders, they weren't getting paid. So if God forbid there was no equity, the house went into foreclosure, maybe just the first mortgage got paid, but not the second. So that's why a lot of people don't want to be in the second position. But it could really come in benefit if you have that opportunity where you have a low rate, you need
Sure.
money, and you just get the cash out on a home equity, not through a regular refinance.
I just want to clarify for myself. So the difference in the sale price and the assumed mortgage is paid directly in cash, correct? So if someone was ready to buy their home in cash and they wanted to keep some of the money just
Yeah.
to themselves, and they could assume a mortgage, pay the $200,000, and then assume the mortgage at such a small interest rate, it's like free money.
Exactly.
Yeah.
That's the way I
Okay.
look at it.
Okay,
Yep.
I get it.
As long as they qualify for that existing mortgage.
As long as they qualify.
Right.
And the biggest thing is you can't shop around. You're only able to go with the current mortgage holder that the seller has. So for people that want to shop around for different rates, well, obviously you wouldn't shop around.
But
for
yeah,
different
you're
rates,
getting a
but terms-
2.5% rate.
Exactly.
Why
So
shop?
what's the fee for assuming a mortgage? Is it a high fee? Is it the same closing costs? Is there
It's
still
actually
title
cheaper.
insurance and all that stuff?
So it's cheaper. You're not pulling another title on the property specifically. You have owner's policy that you are going to look at. So you do want to have the regular stuff the way that first-time home buyers. Do you want the inspection? You still want the appraisal. All that good stuff still plays. There's a small fee for an assumption, but it's a lot lower in closing costs than just a regular front-end refinance or a purchase.
So what's going to happen? You think your client's going to do it?
We're going to give it a try because assuming the house is worth $750, why not list it for $850 and say there's an assumable mortgage?
100%.
And people are still people who want to sell in this market don't want a new home with a high rate. So this is perfect for someone who sells, has equity, puts that entire equity into his property, and assumes a loan.
Amazing. Now, if should they be contacting the bank that's giving them that servicing? Is that who they would contact to assume that loan? Who do they go after?
As a buyer, they would have to contact the seller's mortgage company and
Okay.
find out what the stipulations, what the process is, specifically what's the process on the application to get that started, because the only person that can actually complete that transaction is the seller's mortgage company.
And then it's still the same as getting approved, let's say, as for a regular mortgage. You still want to clean up your finances, have everything in order before you go to that mortgage company and ask for that assumption.
Right, and you might be lucky. Maybe I'm selling the property. My mortgage company is Mr. Cooper. They're very easy to qualify, and nobody has any problems. And that next buyer might have a 640 credit score. Mr. Cooper goes, great, that's right up our alley. But what if my mortgage company now is PNC Mortgage? Now that 640 credit score buyer can't get financing. And they can't go other places to get financing because only that mortgage servicer is allowed to approve it.
Wow.
So you have to have just really good criteria.
Okay.
So these guys are all about the creativity, the creative financing. Are there other creative financing things that we should be talking about that buyers can use right now to get super low mortgage rates?
For super low rates, I want to say the buy down, a lot of the controversy has happened in something called the 2-1 buy down. For people that are listening that don't know what a 2-1 buy down is, without getting into a convoluted scenario, it's 2% lower than today's rate the first year, 1% lower the second year. So let's say today's rate's 5.8. The 2-1 buy down is going to allow a buyer to get a 3.8 the first year, 4.8 the second year, year 3 and on, it would be 5.8 the way it would be today, assuming refinancing wasn't an ability in the next few years. Some people, some critics out there go, well, Dmitry, it still cost almost 2% to get the buy down. And if you're buying a house
Yeah,
for
that makes
500,000,
sense.
that's 10,000.
So why
Here's
do it?
my rebuttal for this. You're about to spend 10,000, which you could get the seller to actually pay for it. But let's say you spent it out of pocket. I think most people would agree in New Jersey and other states, we've made over $100,000 in equity from COVID till today. $10,000 is just a drop in the bucket compared to how much equity they would have made being
True.
a homeowner. And they get a lower rate and minimizes their cost. Not for everybody, but on the side of cost, it definitely makes
But
sense.
only for 2 years.
Only for 2 years. This is in hopes
Yeah,
that
that's not-
refinancing will
That's
come
a great
about.
sounds like a great option.
So this actually helps people qualify for the house. Is that part of what it is?
They're still qualifying on the no rate,
Okay.
so it's not going to like help you lower your DTI, but it's going to help you lower those expenses. Maybe
So-
the $400 or $500 a month that's killing them right now can help them offset some kind of
So
budget.
you're prepaying because you're paying that $10,000, and then you're having lower payments for 2 years.
Correct. Now the interest is going to be in an escrow account because you're supposed to be paying interest at a 5.8.
Right.
You're only paying interest at a lower rate, so there is some interest that's put on the side. But it's a great opportunity for those enthusiasts that think that rates are going to come down. They don't want to sit there and pay a 5.8. In the next couple of years, they can experience lower rates.
So it's really just like a gamble.
But what happens
Exactly.
if
Yeah.
the interest that the payments that you're saving doesn't equal the $10,000? Then it's not worth doing.
It's not going to be like it's the interest that you're getting from the today's rate, then the 2-1 buy down. What happens is it goes into your payoff. So when you're
Okay.
paying off the loan, you are going to have that interest that's calculated.
Got
You
it.
would have paid that interest
So
anyway.
so
Okay.
let's take this
Okay.
from a real estate agent's perspective. If I'm trying to help a client buy a home, but they're stuck on the fact that today's rates are so high, I can pitch this product because it's going to show them that they can lower their rates for 2 years in anticipation of things changing. So they're going to feel less of a burn, I guess.
Exactly. For the first couple years. And some people might say, well, Dmitry, what if refinancing is not a possibility? No problem. Year 3 and on, it'll always be the same rate that you would have got today anyway.
It
does
helps
sound
you
like a good
date it.
option.
It helps you date that rate.
You're dating the rate, but then if the shit hits the fan, you get to still keep-
right.
You divorce the
right,
rate.
Right.
No, you don't. It just converts.
It just converts into a regular 30-year fixed
Okay.
the way it was.
You mentioned the interest payment goes into escrow.
Yep, there is some money in escrow held because you were supposed to pay interest at the 5.8, but maybe for the first year you got the 3.8, so the difference is held in an escrow account.
But what about the 10? You're paying $10 grand to reduce
Yeah.
that rate.
That's just a fee. Yeah. So whether rates come down to 1% tomorrow, they're still you're foregoing that 10,000.
So what payment goes into escrow from?
Just the difference on the rate that you got today compared to what your buy down
So
rate
you still
is.
have to pay that extra
Yeah.
amount every month.
So you have to
Interesting.
figure out what are you saving every month. If you're saving $2,000 a month, it's going to take you 5 months to recover that
No, but
$10,000.
if I,
It wouldn't be. It's realistically, it's only going to be maybe a couple $100 at best that you're saving.
but every month you still have to pay a higher.
That interest is going to the back end of the loan, so you don't have to pay right now. When you sell or refinance, that's when it's due. which a lot of people are not going to care about because if you're putting in $2,000 of interest
Right.
and I just made $200,000 in equity, nobody cares.
Got you.
But you're not going to have to pay extra a month.
So it just accumulates at the loan balance, and whenever you sell.
Correct.
Okay.
As an investor, Omar, are you looking at these kind of things to help you invest in this market, or?
I think the assumable loan
Yeah.
is
Yeah,
a great
that's
option. Not
interesting.
as an
Yeah.
investor, though, because that's for owner occupied for the most part.
Okay.
But with that said, creative financing. Have you come across any subject to financing deals? Because the investor side of this is if I want to buy a property with the existing mortgage, I keep it in that person's name. And it's called take the property subject to the existing mortgage, and I just start making payments on it. It's the whole creative side of it. But the issue with that is every loan has a due on sale clause in it, right?
Right.
And they say banks don't care for it, but I have heard of cases where the banks will call the entire loan due if they find out that the ownership changed on the property.
That's exactly right.
Well, they have to do that
Why?
because who's the next? The collateral, I guess, part of it's the property, but then the other part is the borrower.
But-
the borrower changes.
but
What
so
if they
in-
don't like the new borrower?
They don't need to know. So in theory,
What do you mean? I'm so confused. So wait, you're saying I go up to someone and I say, "Hey, move out, sell it to me. I'm going to take over your payments, but
Yep.
we're not going to tell anyone."
Exactly.
we're not going to tell the bank.
That sounds shady.
Why? Not
Because you're not telling
you
the
just signed a
bank.
bunch of documents that said if I
okay, but
sell,
there's
I'm
two
gonna
things
tell
over
you.
here. The person who's selling wants their mortgage payments made, number one, right? As long as it
Right.
gets paid. So they'll verify you. They'll confirm
They'll
that you
lie
can
for
make
you?
it capable. I don't think they're lying. If you want to sell your home for whatever
This is
reason,
very creative.
but it's happened. I've done it. I wish I could do more.
It happens. Look, I wouldn't be blind to the fact that, and I'm going to come into Omar's defense, where I have a bunch of consumers that
Thank
come
you.
in and say, "Hey, Dmitry, I'm going to live in this primary residence." They signed a bunch of disclosures saying that they're going to live there. The day after, they convert the whole house into an investment. We'll never know. No one's knocking on the door saying,
Yeah.
"Do you still really live there?" So in a sense, it's listen. If you want to ask me from an
That's fraud.
opportunity
No,
of
but-
correct
Fraud.
right or wrong, no, you told the bank this is what you were doing. You're just changing what your mindset is.
That
right?
may
Hold on,
work
hold
one
on.
time.
But that's different though, because in that case, let's say I buy an FHA home, owner occupied, and then I do that. All right, that's
you have
different.
to live there for 6 months,
I don't know if it's 6 months or a year.
1
I
year
don't even know.
now.
anymore.
1 year.
It's 1 year. But if I take that route, sure, there's a gray area there. I'm not suggesting that. What I'm saying is, let's say you've lived in your house for 10 years. You have a conventional mortgage. What difference does it make if I pay the mortgage or if your family pays the mortgage? The bank doesn't know where the
They're
money's
still
coming
getting
from.
their money.
They don't
They're getting
care.
their money.
So
But
in
what
theory,
about? But what happens in this? I'm sorry for interrupting. What happens if, God forbid, the new person that took it over that doesn't say anything stops paying the payments?
Ooh,
Yeah,
what
so
happens
that's
if
the
they
risk.
have it
Detrimental.
now?
There's
Right.
a risk. There's a risk. As there's a risk. with
Uncle
everything.
Jack promised,
But-
but now he's not making those payments.
He's not.
Uncle
But
Jack.
at that,
I
that's
have
the
an
risk
Uncle
that they
Jack.
take.
Right.
And if you were to sell to someone in that position, you'd get a hefty upfront payment to begin with. So you're hedging your bets.
I think that for people that want to take real estate investing seriously and have multiple investments and move on and grow their portfolios, that's all way too dangerous to get involved in that stuff.
I
Because you
disagree.
get one fraudulent scenario,
fraud.
and people don't want to work with you.
No, but it's not fraud. You're helping someone get out of their situation, and these
It may
circumstances
not be
arise.
fraud as the person taking over, but it's fraud as the person that got the mortgage.
I disagree.
Somebody's
But
committing fraud.
in a
there.
conventional loan, the mortgage documents don't say no one else can make your payments. Now, the due on sale clause is the concern here, right?
Correct.
Because the bank has a stipulation in there that says that for whatever reason, they can just call the entire loan due. So
Yeah.
if that happens,
If you sell it, yes.
no, but it doesn't say
You're
that if
saying
someone
just
else.
swap it and live there,
Oh
but
wait,
not
they
sell
can
it.
call no matter what. I mean, you're
There's
saying
some
that it's not
stipulation in
if
there.
you sell it. It's just that for whatever reason they can just call the
I
loan
don't-
due in
not-
full.
Not for whatever reason, but there's
Okay.
some.
No, I think you could rent
clause
the
in there.
property and your mortgage wouldn't be called. It's if you transfer the deed, that's
Got
when
it.
they call the
That's-
mortgage.
that's
when
it.
they transfer.
Okay.
Like, put it this way,
Okay.
my dad
Yeah.
died in 2019. Nobody ever came, and to this day, I'm still making the payments.
There you go.
Not
Right.
one
So what
person
difference
ever
is it?
said, "Where's
But
Andre?"
the deed is
Payments are
probably
made.
still in his estate.
Exactly.
Yes.
Now, if that
And
deed
that's
was to
okay.
be changed, there's a risk that the bank
Yep.
can call it.
Yep.
They
Agreed.
will call it.
They won't always call it. There's a,
Well, then the
why would
bank
they even
is an
try?
idiot if
No,
they
but,
didn't call it.
But why would they? If the payments are coming in, that's the gray. I don't have an answer for that. But
No, it
sometimes
is a
happens.
gray area. Not always. Usually, it would be a due on clause, but if not, and they're saying, "Hey, I'm making my payments. I'm getting my payments. Everything is fine and dandy. Nothing is being messed up." They might not give you a problem.
Yeah.
The ones that want to live more on the right side of the fence, where it's everything's done the right way, contacting the mortgage servicer and letting them know what you're looking to do is probably the best bet, because now you're exposing what you're trying to do to the
Sure.
bank. But it can cause other issues. Now
Yeah.
you're raising awareness that, hey, I'm doing X, Y,
If
and
you're,
Z.
They won't
if
do
you're
it.
the son of the person who died, and it's your house to be inherited, and that loan, I have no problem with that. If the bank wants to keep that loan in place for the next 30 years, I don't have an issue.
Well, why not?
It's
though?
the
What
transfer.
But why not have an issue with that if you
Because
don't know
it stays
who the
in the
buyer?
estate.
But
in
you
the
don't know
name
if
of the
the-
person who had the mortgage. If
But
the
you don't-
bank's okay with
okay.
that, who cares?
But the bank doesn't know if that next person's
The
capable.
bank
of
knows the
making,
person died.
But they don't know if the next person's capable of making payments.
At that point, it doesn't matter.
Why not?
I don't have a problem.
It's
with
the
that.
same argument you're making.
It's
if
not
it was
because
not a
the
family
deed isn't
member.
transferred yet,
The deed issue I
which
get,
means
but
that the bank still has that collateral through that initial borrower. There's no issues.
based on
And
that
you can't get a
borrower's
secondary
ability
loan
to.
on there because nobody. There's the guy's dead. He what's the estate? No one's going to give the estate money.
No, I agree, but
So
the
I'm
concern,
okay with that.
the concern is still there because the next person making the payments, how does the bank know that person's qualified to make those payments?
Well, we
They-
know
they
the person
don't.
who's dead can't make.
They
the
don't. But
payment,
if the
so.
person stops paying, then the bank forecloses.
So we come to the conclusion that as long as the bank gets their money, they don't care.
As long as
In
they
theory.
get their money and no one transfers the deed, they don't care.
So,
The deed part
And I don't
is
care.
a great area.
I think it's fine.
So basically, banks are crazy.
so last thing, are there any dangerous loan practices that we should be on the watch out for?
Yes.
There's
Like
a lot.
this one, like
This would be one of them.
the top two.
Non-QM loans, which is a huge opportunity for many people right now. Non-QM loans stand for non-qualified mortgages. So essentially speaking, you're not qualifying based on tax returns or traditional ways of verifying income. You could use somebody who's a W-2 employee and say, I only want to just give you my most recent W-2. You're not getting pay stubs from me. You're not getting anything from me. You have people that are self-employed that go, I don't want to show you my tax returns because I'm not paying that much money to Uncle Sam. I want to just supply a profit and loss or bank statements. So it's almost like zero common sense because we're telling everybody in one side of the fence, hey, do not deposit cash, don't do this. And this other person saying, do me a favor, only deposit cash. So non-QM loans are a little riskier. I look at them as a subprime loan 2.0 because I was in the business in 2008 when all these loans imploded. Now we're telling people, as long as you're putting down 10%, you're good to go. Whereas before, it was no because nobody was putting any money down. But now, all of a sudden, you put 10% in front of it, it becomes a lot more responsible.
So they are.
I see a
they
big
are
problem.
more riskier.
Yes,
However,
absolutely.
we still need them for
Yeah.
people that are self-employed.
Yep.
And I think that the rules for the regular traditional mortgages are so onerous that self-employed people would never be able to buy a house. So
Agreed.
I
Exactly.
think that
Yeah.
it's super important. Check the person's credit score. If they have good credit, then they deserve whatever they apply for. Because if
They've
you have a
demonstrated
history-
financial fitness, you're right.
Exactly. And if a bank's willing to do it,
Yeah,
Agreed.
I agree.
Another loan program I really think that is dangerous, but it's happening, and I've done loans myself, so I'll be the first one to say it works, is using rental income on a property that you haven't had a renter yet. So if you're making $60,000 a year, that's $5,000 a month. You could potentially go buy a two-family house, say that this next unit is $2,000, and they'll give you 75% rental of that projected rental income to add on top of your income. Why do I think it's dangerous? God forbid you don't get the right renter, you don't get the right money. Now you can't afford that payment no matter what. And that's the biggest issue. Places like New York, New Jersey might take you a year to get somebody out. You can't afford it based on
Yeah.
your $5,000 income, let alone you getting projected rental income that's not even there. So again,
Good
it
point.
helps people, but it's also very damaging as well.
And for commercial loans, people use tenants to qualify for loans all the time. And I
Right.
see how important that is for the two-family residential house. I do think it's less risky because it's very easy to rent an apartment as long as you're putting it out there at the right price. Where my concern would be there is if you have someone who's a first-time landlord that has no understanding of what they're getting and they don't qualify the person properly. As you said, the person gets in, they don't deserve to be there because they don't pay. And now this person is stuck for a year living free and then the house goes into foreclosure. I think you have to know where you're buying. Every state in this country has different laws. I even think some of the counties have different laws. New York City specifically is a challenge. And once someone gets in and they don't pay, I've heard stories of people not paying for a year.
Yeah.
So yeah, if you're a first-time buyer and you rely on this tenant and you have no experience, you
Yeah.
will lose your shirt. You
Yeah.
will lose everything.
Absolutely.
So I see where that's scary. Just make sure you know the rules. Make sure you have good attorneys, and
Yeah.
go to a state that allows you to kick people out when they don't pay.
This is why I invest in Jersey, not in New York, just saying.
There you go. I
So,
second that.
on that note, everyone needs to subscribe. They need to like so you can find out how to avoid these.
How to assume a loan.
How to assume a 3% loan. Yeah,
go.
that's exciting.
And then also, people need to buy this house that Omar's trying to sell with a 2.2
Coming
I
up.
know.
Reach out to me for it.
And if they don't buy the house, then they can get your Find Fun Flip at recareercenter.com.
We talk about
your
these things in it.
course,
Yeah.
you do. Omar's awesome. Thank you so much, Dmitry. We
Of course.
appreciate
No,
it.
thank you guys. Omar, thank you. I learned a lot as well.
Appreciate it.
Really good stuff.
Thanks for watching this episode. Now don't forget to like, subscribe, and leave a comment. And we'll see you next time.